Hello, everyone. Welcome to the first video of Module 1. This is Chapter 1 of the textbook. We're going to be discussing just an introduction to the federal taxation in Canada. Module 1 has a lot of talking. All the chapters have a lot of talking. There's lots of rules to go over, but future chapters have a lot more opportunities for us to stop and do some math and do some calculations. And so that has the benefit of kind of breaking up me talking. And although we will do a little bit of calculations in chapter 1, there's not that much. So get comfortable because I have a lot to speak through. I'm going to do my best to keep these videos as short as possible because I want the information to be bite-sized if I can do so. So I try to keep them 15 to 20 minutes on certain subjects. For long, complicated subjects, I will tend to go the 30 minutes because I do like to connect the exercises in the textbook with what we covered. So I will do my best to keep it to 15, 20 minutes, probably about 20 minutes. But if it goes a little long, hopefully those videos are few and far between. So let's get started discussing federal taxes in Canada. One thing to note is that this first chapter, we're focusing on answering three questions. One is who is required to pay income tax? How is income tax payable determined? And when and how does one go about paying income tax? There's a schedule. So to jump to question 3, just because I think that's the quickest, is when we're recording our income, individuals, humans, we tend to do a calendar year. So January to December. So we keep track of all the money we make in a year, and that's what we're going to report and pay taxes on. Corporations don't have to follow this line. They can choose any 12-month period. A lot of them will still use the calendar for convenience, but there's lots of corporations that might have, March 1st to February 28th, or, July 1st to June 30th. So calendar year is often what we're talking about because you and I are individuals, but it does not need to fit the calendar year. So that covers sort of, maybe not the when, but certainly the time period. Anyway, so who is required to pay is residents and non-residents of Canada. If you are a resident of Canada, you live here in Canada, or you can live elsewhere if you are still as a representative of Canada, or if your major ties, your family, your bank account, your main place of work is still in Canada. If you are a resident of Canada, all of your worldwide income is reported to Canada and you will pay taxes on it. If you don't live in Canada, perhaps you live in the States and you have some Canadian investments, or maybe you have some business interest that takes place in Canada, then you will report and pay tax only on the income that occurred in Canada, or from gains on dispositions of certain types of Canadian property. So if I'm not a resident of Canada, I still need to report my Canadian income. If I am a resident of Canada, I need to report all my income, whether it's Canadian, German, Britain, US, Brazil, like you have to report your worldwide income. Um, so there's 4 steps to calculating your income tax payable. We're going to be talking a lot in this chapter about step 1, which is net income. This is also known as Division B income. Division A is the part of the Tax Act that determines who pays taxes. It outlines the criteria for who is a resident, who is a non-resident. Once we get past that division, the next few divisions are about the actual calculation itself. So Division B calculates your net income in a given year, but not all of that income is taxable. So when our step 2 is figuring out how much of our income will have taxes applied, and that's called Division C. Division D is like Division C, but it applies to non-residents. And then Division E is where we calculate our gross taxes and what tax credits we can use to reduce it. So right now, Pretty much step one is what we're talking about in this chapter. Taxable income we get into in chapter three. Personal tax credits we discuss in chapter four. So we'll take you through these steps, but remember that division B is where we start, and that is for our net income. Um, Taxation is very much tied to accounting. We have a lot of the same principles, but accounting principles are used to measure income in a business sense. We produce financial statements. And although income tax has ideas that are similar, the tax rules are laws. Accounting principles are practices and guidelines. So, although we might have similar treatments, income tax rules don't always follow accounting principles. And you're going to see this a lot in chapter five when we're talking about capital cost allowance. It's similar to the accounting principle of amortization, but it's a lot more structured in how it is carried out. So the Income Tax Act operates on a basis of law, property, contract, corporate. It can use accounting principles if there's a new accounting principle that comes in and there's a tax law or there's not a tax law to cover a certain treatment. So like, for example, when cryptocurrency was a new thing and came into place, sometimes the Income Tax Act will use accounting principles as a framework until they can establish a structured law. But the Tax Act follows the law of income reporting. So we have our income. Why do we pay taxes? So the government collects taxes in order to pay for public services and resources. They collect money from various different tax sources, and that money is supposed to be used to provide things to society. So they structure roads, they have healthcare and hospitals. They fund military. There's supposed to be collective benefits to the use of taxes. But from where does the government get most of their tax money? By and large, personal income tax returns is where almost half the funds come. Right now, 47.2% of our government budget comes from personal taxes. This has come down somewhat. There have been years where that number was over 50%, so it was most. But even if that's the case, corporate income tax, the second place tax source, is only 17%. So personal income tax, by and large, the biggest source of tax revenue for the government. Sales tax is another big portion. And then we have non-resident income tax is 2.6%. So non-residences that do have to report Canadian income are themselves a small source of income for the Canadian budget. There's a few more slides on the alternative tax basis. I'm not going to go through too much of this because they are talking about, excise and similar taxes, new taxes in Canada. That's not going to be the focus for this course. This is an introduction to Canadian taxes. So I'm going to just kind of pass over the next few slides. Yes. So on the note of who pays taxes, we know there's residents and non-residents. But who can be a resident? As far as the Tax Act is concerned, there are three types of persons. The Tax Act often refers to persons, and they mean one of these three types. Individuals, being you and I, human beings, corporations, or trusts. And each of these entities have their own tax return form. So individuals like you and I, we would file a T1 return. Corporations, when they report their income, file a T2. And for those who can find the pattern, trusts file a T3. So we file our tax returns in this way because we are the three taxable entities. So when you're looking through the Tax Act, if you see it relate to a person, they can be talking about one of these three types of entities. If they are actually talking about human beings, they will likely use the word individual or natural person. There are other business types. So we have sole proprietorships, we have partnerships, we have joint ventures. The thing, maybe not joint ventures, because that I think is more of a type of corporation. But the point being is these three types are relationships. They're business relationships, and they get sort of flow through to these three entities. So a partnership Although mentioned in the Tax Act, is a legal business relationship, not a taxable entity. So if a partnership makes money, you can have a partnership between two corporations, a human and a corporation, a trust, and an individual. So partnerships are in business together, but the income from that partnership gets divvied up amongst them, and they will report it on their own tax returns. So even though a partnership can earn income, that money would flow through to the individual. A sole proprietorship is a business run by a human being, an individual, and they report that business's income on their personal tax return, a T1. So we have a lot of different types of businesses, but the Tax Act only concerns itself with three types of entities: individuals, corporations, trusts. Yeah, and I mentioned so there's sole proprietorships, partnerships. Sole proprietorships and partnerships are not taxable entities. Individuals report T1, T2, T3. If corporated business, the business owner is a corporation, reports on a T2 tax return. Yes, so corporations are legal structures that are separate entities from people for tax purposes and legal forms for liability. Along with these three entities, there's also tax exempt entities. So these are municipal governments, labor organizations, registered charities, and certain trusts and education plans. The point of these entities are many of them are not for profit. They're not created for the purpose of making money. They're created for the purpose of distributing funds to be used by, if you're a municipal government, people in a city. For a charity, you're helping underprivileged demographic. So, although a registered charity, if they're incorporated, might file a T2, it's mostly for information purposes. So, registered charities are not taxable, they are an exempt entity. GST and HST, tax collected on sales of goods and services by a business owner, belong to the government. Now, taxable entities for sales tax are not the same taxable entities for Tax Act purposes. Sales tax is a result of business activity. If I go into a store and I buy a movie, that movie will have sales tax on it. So I will pay taxes for participating in the transaction. So the sales tax is related to business activity, whereas entities for the Tax Act are based on individuals, corporations, and trusts. So what does that mean? What that means is, although a partnership is not considered a taxable entity for tax, that partnership is partaking in business. They might have products or services they're buying and selling. So their customers will have to pay sales tax on those goods and services. So that partnership is an entity for sales tax, but not an entity for federal income taxes. Okay, so I want to take a pause there and go to our first couple exercises. So now that we've discussed a bit of the course material, I want to go directly to the exercises from the textbook that relate to what we've talked about, and I'll try to keep that pattern as consistent as I can through these lecture videos. So exercise 1 in chapter 1 is talking about taxable entities for income tax purposes. So we have 6 entities here. We have Max Jordan, an individual. Max owns a hardware store that he runs as a sole proprietorship. There's also a partnership, Jordan and Jordan, that perhaps he runs with his family or a sibling. And the Jordan Family Trust, a trust that's constructed and the beneficiaries are Max Jordan and the rest of his family. Jordan Enterprises is a corporation, and then we have the Jordan Foundation, a registered charity. So here's 6 types of entities. Which ones are taxable? So we know that we're looking for the 3 basic types: an individual, a trust, or a corporation. So Max Jordan, the individual, is going to be a taxable entity. His business, the hardware store, is a sole proprietorship. That business is going to report income, but it's going to be taxed in Max's hands. All of that income is going to be reported on Max's personal tax return. So this sole proprietorship is going to be reported here. The partnership between Max and perhaps one of his siblings will make money. The income and profits will be split between one Jordan and the other, and that income will also go and be reported on Max's personal income return. Um, yes, so these business relationships have, I think the term is flow through. So the income that's created flows through the relationship to the entities to be taxed. The Jordan Family Trust is a trust, so it might have investments and earn income in its own right, and that income will be taxed from the trust. Jordan Enterprises is a corporation, so it's its own entity. It will file a T2 and be taxed as a taxable entity. The registered charity, although incorporated, might file a T2 for information purposes, but it will not pay taxes. It's a non-taxable entity. So it doesn't follow the same taxable entity as a corporation. So if I go to this solution sheet, I produce these spreadsheets. They are uploaded on Module 1, so you have access to them. And this is a way for you to have at your fingertips the thought processes and calculations that I discuss in the videos. So Max Jordan, individual. Individuals are taxable. The hardware store is a sole proprietorship or an unincorporated business. That's a no. Partnerships are not taxable. Trusts and corporations are yes. Registered charities are no. The next exercise has the same 6 entities. Which of the following are considered separate entities for the purposes of GST and HST, our sales taxes? Max Jordan can partake in an activity of business. Now, business activity for an individual is considered a sole proprietorship. Um, so there's some clarification here, but generally, anyone and anything that partakes in business is subject to sales tax rules if their income is high enough. So Max Jordan and the hardware store are both applicable for sales tax. The partnership will have sales tax if it's partaking in business, the trust, the corporation, and even the charity. Sometimes charities can raise money by selling goods. And if they are selling goods, then they should be collecting the sales tax from those transactions, and they may have to be remitting those. So our solution spreadsheet for those same 6 entities is going to look slightly different when we consider the sales tax application. So for GST and HST, it's a yes for everything. Anything can be applied for the sales tax because that's a matter of activity, not entity type. Okay, that takes me to about 17 minutes. I think I'm going to stop this video here, video 1, and I will see you in the next video where we will discuss more on the rules of taxation. And I think we go into federal and provincial taxes, and we're going to talk about the tax system. So thank you for your time. See you in the next video.